raising money for other stuff world, but I've never really done like a tech type of raise. And I see, you know, and I know a lot of people listening may not have either, but you see things like Series A, Series B. Just talk about the structures as these founders. If somebody who's maybe a founder who's thinking about raising money, what does it look like when these companies go to raise money? Do they sell a minority interest in the company? Are there different share classes? I mean, I know it's probably not all the same every time, but just walk through some of the structures that people could expect if they were thinking about raising money for their startup.
Yeah, there's a lot that goes into that. I would tell you that in Oklahoma, it's probably not the best to get caught up in what we call the round. Mm-hmm. You know, seed round, Series A round. I think it's important to remember where we sit. We describe Oklahoma as an off the beaten path market. Yeah. We're not a traditional tech hub. And frankly, we love to invest in off the beaten markets. And I'd love to kind of get in why we think there's an opportunity there. But you know, a seed round in New York City or a seed round in San Francisco, a seed round in Austin, all look probably different than what a seed round in Oklahoma looks like. Mm. And so I would tell you, like, don't get super caught up in is this a seed? Is this a Series A? Is this a pre-seed? How do we kind of view that nomenclature? I wouldn't get too wrapped up into that. There is kind of a natural progression. You know, as you think about the rounds, pre-seed, I'm pre-revenue is how I tend to think about it. Or I'm very early kind of in the revenue game. My seed round is kind of, all right, I've got real revenue, real traction. Some of that's starting to flow. It's kind of my second round. Maybe the first pre-seed round is friends and family. I've raised a little bit of money. You know, seed, I'm going out to raise $1 million or $2 million, or maybe up to 3 or 4 into that round. And then Series A, I'm $5 million plus, right? And I've got $1 million of ARR coming into the business. And so new capital is really going to drive that. In terms of structures that we see, we tell our people we're not picky about how we want to do that. You know, they have a safe note mechanism, a simplified agreement for future equity. That's very, very common in the early stages. As you progress forward, you tend to see a lot more, you know, what we call a convertible note, and then you'll move into a price round where the safes and the convertible notes are a little easier to put together when valuation is a little tougher to identify. As you progress your company, you're going to move into more of a price round where an investor can look at you and say, okay, I see what your bottom line revenues look like. I can give you a multiple on that money. Here's what I value the company at, and I'll invest at that dollar amount. And so that's the right way, I think, to probably think about those different rounds. I think a lot of times people get too caught up, frankly, in the nomenclature of what we call them. Just think of the underlying business fundamentals, what allows you to invest and protects the investor. We look at those notes a lot as what are the protection mechanisms, whether that's a discount rate on the next round, an interest rate tied to the note that you're signing. Those types of mechanisms are there really to provide protection to the investor.
And this is more my ignorance around it, but it's like, are they selling down a minority stake? Is it just a pin? Is it a majority stake? I mean, like, I know in private equity, the founders own just a very tiny sliver.
That's right.
Right. Yeah. And then like in real estate, you know, maybe you're a GP and you own 10% or 30% or whatever, but you got these LPs that still own the majority, but you get a fee and then they get a back end. How do these structures, like along those lines, how do they look?
Yeah, so we are typically minority investors. Okay. You know, we're buying 10% or less of the company. Right. Now, the reason is we think they're worth, or could be worth, you know, big multiples on our money. So we're trying to keep incentives aligned here where we can still go make 10 times our money, and that the founder who's built the company is really motivated to go be $100 million plus company.
Right.
And so we tend to be minority investors. I think, in our opinion, that's smart. It's probably something that I wish more Oklahomans would kind of get out of this. You know, I got to invest and I have to own it in order to keep some level of control. In most of the cases, especially in the places we invest, the local investor is not the smartest person to be a majority owner anyway.
Yeah.
And that, I mean, listen, I think there's a ton of smart people, but you have to, there's a bit of understanding your own limitations and time and commitment of what it would look like to own a majority interest in a company. And so for us, we're trying to convince people we're buying a basket, you know, of investments through this fund model, like call it a mutual fund of venture investments. Your goal is to own minority of a big bucket here that can all return 10 times your money.